Larry, good morning to you. Thanks for doing so. I saw in your notes you were commenting on the choppy process of establishing an equilibrium in U.S. rates, but also how the 10s at current levels warrant acknowledgement.
Yeah, I mean, we're in this like sideways shuffle, as it were. I mean, even last week, 10s were 97 basis points. We backed up to 86, 87. A lot of that is just worrisome that the incoming data is not supporting the level of rates. And so we saw that yesterday with retail sales. We saw that with import prices. But on the other hand, let's keep in mind that at 87 basis points, it's much higher than where 10s were between June and October of this year. We're just consolidating, shuffling at this higher level. And I think a lot of that is just a conundrum where people are thinking or they're hearing from the Fed that we're encountering a dark winter. All that to say, is the Fed going to come in and rescue with more stimulus? Is there going to be fiscal stimulus? And I think that's what's helping us consolidate in this range that we've seen over the past few days.
All right, will the Fed come in? I mean, with rising rate counts, many would argue that that could prompt them to come in. You actually commented on that in your newsletter, if I remember, which I really enjoyed, Larry, and very well written. I wanted to get your thoughts here, though. What would that ultimately mean? What's the Fed's next kind of tool or process here at this point? I mean, they've made it very clear they're reluctant to go negative, and then on the other hand, a willingness to maybe provide some sort of a yield curve control. But what would that next step be if they are prompted to?
Yeah, I mean, if they're prompted to do something, I think it's the latter. I think it's what we call the weighted average maturity or WAM extension. And I think that's one thing that might be putting a cap on 10-year yields presently, because consensus is saying, well, it's not like the Fed is out of bullets. They're clearly not. However, the least path of resistance for them would perhaps be WAM or weighted average maturity extension, and that is kind of watering down any upward trajectory or continued upward trajectory in yields. But I guess the bigger picture is really the market's also looking at fiscal stimulus. Will that occur if COVID case counts continue to climb, et cetera? That's not the least path of resistance presently, but I think that would affect the market a lot more directly. And so I think there's two things going on, and that's what's causing this consolidation that we're seeing over the last few days.
All right, consolidation over the last few days. Talk to me about the influence that, well, we were just looking at the chart here, the ES near all-time highs. We were talking about at the top of the show. Everybody's talking about that this week, for that matter. You've got rates to the downside, which have been somewhat supportive, and again, in a range here off the extreme lows. But I keep saying we got to keep an eye on the March highs and lows as long as we're in that range. As you noted in your newsletter, very choppy and limited in terms of directional conviction one way or the other. But talk to us about what does this all mean for the U.S. dollar, because the dollar's been weakening a bit as well. We're starting to hear, as I mentioned at the top of the show, about potentially more stimulus. Many people, analysts, and maybe you would probably agree that the argument here is not so much if, but when. Ultimately, that could weigh on the dollar. I say if, but when in terms of stimulus, not so much if, but when, and that could weigh on the dollar. Where do you see the dollar right now, and ultimately, because that's a major focal point here in terms of the ripple effect as we already talk about commodities, gold, copper, silver, and others, beans. You could say it's the hub in many ways and connected to a lot of spokes on this wheel. What do you think in terms of rates right now in the dollar and that relationship?
Yeah, and so I can't wait to listen to what Bob has to say about it. But for me, I continue to be a dollar bull, being fully aware of the fact that I think there's a negative risk premium associated to the dollar right now, because there is so much consensus out there that the Fed is going to act. And I think, in other words, I think that might be already factored into the market, or at least the pricing of the dollar against the majors. But so the way I see it is that, we're eventually going to have some sort of stimulus, whether it be fiscal, whether it be monetary. But the fact is, we're not the only country that's dealing with this right now. So again, maybe there's a lag effect, but I do think the dollar has been weighed on, and it's not like a lot of these other currencies are cheap. But I do believe that when you consider like the euro, for instance, I mean, I think the ECB at some point is going to have to do something as well, or continue to do something, because they already are putting in enacting stimulus. So I think intermediate to long term, I continue to be a bull. It would not take much for the dollar to rally, because I do believe there's a lot of risk sentiment associated with the current pricing.
All right, I like that a lot. You say, again, overdone. We've been hearing about overcrowded as far as this trade, basically the same thing. And, you know, without inflation, which I want to get into in just a second here, and with some of the weaker than expected economic data that you were just talking about, the retail sales, we were talking consumer sentiment, how that's been a little bit soft recently as well. Again, and especially lack of inflation in theory, well, that would weigh on the dollar. But let's talk about if we were to start to see some inflation, that could provide a little bit of a lift there. But for the most part, still have yet to. We just talked about the UK data, inched a little higher in the overnight session, but one data point does not a trend make. And certainly, Larry, the trend we have been seeing has been inflation's been very muted. Obviously, that could change at a rapid rate, though.
It could change at a rapid rate, and you know, I just need to do a self-check, because you know I'm kind of an outlier with regards to inflation, or lack thereof. I mean, I do think there's been enormous structural changes that we don't even see, that we're in a world where I don't think we'll see inflation for a long, long time. And so with that said, a couple of data points might be helpful, might do something to sentiment, but the bottom line is I think we're just in a zone where deflation is more of a risk than inflation, especially if you continue to have this monetary stimulus pumped into the system. So do we have a chance to have some short-term inflation? I think we do, but I think, you know, intermediate to long term, I think it's just lower for longer, and that's going to impact the dollar, the cross rates, credit spreads, interest rates, and thus the stock market.
Larry, one more question. We'll let you get on with your day. It seems like we kind of enter in a little bit of a void as we head into the end of the week after a lot of focus on last couple weeks, the election, central bank activity. Obviously, investors are dialed in on some of the coronavirus news that we were talking about at the top of the show, and as we've been talking about the new all-time highs. But what do you have your eye on here right now? Corporate news, retail sales is going to be a major focal point, getting more information about consumer trends. But as we head into the end of the week and into the end of this month, for that matter, with the holidays coming up, what should we be watching?
Well, I think today is actually a big day. We have 4 Fed speakers, and that's what I'm watching more than anything. The data points are, I watch them. Today we have housing starts, building permits, which is a hugely important number given the trajectory we've seen over the past few days. But I think headlines matter so much more than economic data. That when you have 4 Fed speakers, whether they're official or non-official economic statements, I think that's helping to move or not move the market more than anything else. So I would just keep my eye on the headlines, and obviously any news on COVID is important. But I do believe Fed speakers, ECB speakers matter much more right now than anything else.